Hey, everybody, and welcome back to another episode. I'm your host, Brandon Cobb, co-founder of HBG Capital. And today we've got Patrick Grimes on the show. He's the CEO of Passive Investing Mastery. He's an international best-selling author, a Forbes Council contributor, a serial entrepreneur. He specializes in alternative investments. He's got multiple businesses that he's been wildly successful with. He's got a very interesting investment strategy around one particular type of lending that I'm very interested today. We talked about it a little bit before, and I got so excited. I was like, all right, let's just hold the rest of it for the show. So we're going to get into that today. Patrick, welcome to the show.
Brandon, really excited to be here. I mean, the name of your show resonates with me. Recession-resistant real estate. I lost it all 2009 and 10 during the subprime mortgage collapse in real estate, and I spent the rest of my life trying to figure out how to build more resilience into my alternative strategy. So I think we're talking the same mind today.
Yeah, I want to get into that too. I know people listening are going to be interested on what changes you've made because I think some of the names of your funds and investments are, they have the word recession in it. So we're going to get to that. But for those that don't know who you are, that are meeting you for the first time, listening on Apple or watching on YouTube, what's your story?
Yeah, so like many of your listeners, I was a high-paid professional. I did machine design, automation, and robotics, automated manufacturing, and medical device, and aerospace, defense, and automotive. Did stuff with Tesla, Raytheon, Abbott. Really fun, really cool stuff. Did well with it. Mechanical engineer, got a master's in engineering and an MBA as well. Started making some bonuses, and I realized I was like, well, where am I going to invest this? And at the time, I was kind of in this Silicon Valley and some other places where I was just all these really cool startups. And I was thinking, I'm going to invest there. I asked the founder of the company that I worked for at the time, well, you're a titan in this space. Like, what are you doing? Like, I'm going to invest alongside this guy. And he threw me off footing entirely. He said, go invest in real estate. He said, make all your money in high tech and invest it in outside of high tech. Invest more as soon as you can, as much as you can. And that was interesting to me. So I realized that he, having been around the block for a while, realized that the ebbs and flows of, the stock market, technology, and the high tech space isn't going to get you to where you want to get in the long run. And that's what led me down the alternative investing path.
Interesting. So you've done a lot here. You've got a very particular strategy, the litigation lending or litigation funding investments. We talked about it a little bit before we got on the show. What exactly is that?
Well, at the heart of it, it really is at my investing strategy. So backing up a little bit, I am, as we talked about, looking for recession resilience. I'm also looking for something called non-correlation. And like, what is that? That's when you invest in one industry or one market or asset class, and that's all you're in. You're going to be highly correlated. Your worth is going to go up and down with the ebbs and flow of that. So while you might have financial independence in real estate, if you're all in real estate, that can disappear overnight. That's what happened to me, right? So it's about not just financial independence, but financial stability. And that is achieved by investing into completely different kinds of investments. So you have foundational pillars that don't rise and fall together. So your wealth stands more stabilized. And that means you got to go kind of into these kind of quirky, unknown, more novel types of investments, like not just the stock market and real estate, but maybe in energy or in medical. People need healthcare in recessions, and it's fairly recession resilient. In education, people need skilling and upskilling in downturns or in upturns. And the legal services, turns out legal services like education and healthcare is very recession resilient. Mm-hmm. And those needs for operators in the legal industry, for capital, just like operators in real estate, they need capital to operate their business. They need capital, just like a real estate guy, to buy a building and improve a building so we can provide housing to tenants. Attorneys, sometimes their clients can't afford to pay them for services, to pay them for the defense, to pay them to get access to the justice that they would deserve. So the attorneys would say, look, you've got a great case. I would love to work under a contingency fee basis with you. So I want to give you access to justice, but then they've got to turn to somebody like myself, because attorneys, it's a very simple industry. They just court fees, filing fees, hourly rates. got a bunch of people to support these clients. And so we can lend into the legal industry, operators in the legal industry with a track record of success. We can then provide them capital, just like we do in real estate and our debt fund, to either acquire more claimants, acquire more clients, or increase the size of their docket, the number of clients they have, or the operating expenses necessary to represent those clients to get them to a settlement offering. And they'll provide those claimants with access to justice. In exchange, they'll get a contingency fee, a split of the settlement amount. And then that agreement becomes our collateral, just like in real estate, how you have a lien, you have an asset, which is the property. We have a lien, we have a UCC1 filing, and an asset, which are these agreements that they've signed that gives us a preferred position on payouts and a waterfall on the profits.
So you're not lending to the client of the attorney who doesn't have the money to pay the attorney for the case. You're lending to the attorney who tells the client, hey, you don't have the money to pay me. That's okay. I will pay for all of your legal, I'll hold the bag on what you owe me, and I'll pay for all your recording fees and filing fees. And in return, I'll get a piece. You'll reimburse me on the back end plus pay me my profit because I'm so confident that I'm going to win your case. I'm willing to do that. And the attorney might not be able to finance all of those costs. So he comes to you and says, hey, I want to get a loan against this agreement that I have with my client. Is that right?
Right. Mm-hmm.
So I'm going to compare it to real estate because that's what I know. In real estate, you mentioned that there's a lien filed on the agreement. In real estate, there's a lien filed, a deed of trust on a particular piece of property. If a bank's going to finance it or a lender's going to secure a first position mortgage, and that gets recorded down at the registry of deeds. And so when someone goes and tries to sell that piece of real estate, they can't without that lien getting released, that deed of trust being removed off of it. In this case, how is your company protected with that lien right? Like what's preventing the attorney from, I guess getting paid out from the court system? I don't even know where the money comes from. I guess there's a decision. The judge or the jury has made the decision. The money is then taken or given to the court system and then paid to the lawyer. How do you make sure you guys get paid?
Yeah, so you hit it. It's just like any kind of asset-backed lending strategy. And there are actually lots of asset-backed lending strategies out there, and they all work similarly. So first, you've got to get a value. We've got appraisers in real estate, and you have law firm valuation specialists in the legal industry, and that's all they do. And by the way, this has been around for a really long time, since 1910, so it's a very, very large industry. And then when we go to do a financing agreement, we're looking for skin in the game and track record. We'll put the financing agreement just like you do with the loan document inside real estate. But we have attorneys that this is all they do. They've done hundreds and hundreds of these and billions of dollars of these legal litigation finance funding agreements. And then we do the background check. We do the UCC1 search on the law firm. And then we file a UCC1 lien against the law firm. And that allows everybody else that comes and does a search, is this law firm credit worthy, right? Because we're lending on corporate assets, these agreements, they'll find that. And then we can produce the financing agreement says we have literally a preferred position on these individual clients, right? Mm-hmm. Whom our valuation specialist has gone and looked at all their files, verified that they have the agreements in place, verified that these individuals have medical records that say they have this issue, verify that they've had this exposure to this harm, and then verify that is a result, that it's applicable to this particular case against this one defendant, this kind of bad, evil organization that did this harm. And so we have these people that come and verify that, and they said, yes, that's right. And so here's a value for what this is worth. And like in real estate, people lend 60, 70, 80, 90% on loans, but in litigation funding, we'll do 10, 20, 30, 40% on those collateral values. And that's how we work it.
Let's unpack a little bit of that. So this is interesting. So I'm going to try to back up and do a little apples here. Apple with real estate is the registry of deeds. The deed goes and gets registered at the registry of deeds. So there's a public ledger, and that deed can't get released until it's paid off. Here, you said there's a UCC, I believe, one filing. And is this like a ledger of all the attorneys? Is this like a database that I guess lenders go to? Like, who might want to use this
Yeah.
database? And why should an attorney care about having a good reputation and not having liens filed against their name? Because I mean, I guess he could just go and file a bunch of liens on him, but if he, let's say he doesn't need to, I guess receive money in the future for his business, then he'd shut down there. I mean, does this affect his personal ability to borrow funds for other things like buying a home or something else?
Well, so we're only lending to, respectable, reputable, just like in real estate. If it's an organization that's lending from us, we want to see, do they have the assets? Do they have the skin in the game? And oftentimes they're putting up existing collateral that is many times what ours is. And so, yes, the UCC ones is very proliferate when you get outside of real estate. That's how the rest of the liens in the world are filed. And that allows us to actually stake a claim to specific, agreements that they have in place.
But it's like a judgment when a judge issues a judgment in like the circuit court and says, okay, I rule in this person's favor. This person owes person A owes person B money. There's that judgment, and then that judgment kind of goes out on a lot of the assets that person or entity owns.
Well, the judgment is a different thing, because that would mean like, hey, look, we had this UCC one and they're not paying us. So then we would go after to the courts to then, force the payout or seize assets. And our contracts allow us to like sometimes to move collateral if for some reason they become insolvent or whatever it is. So it's kind of a complex thing the way you're trying to describe it, but actually it's just really simple. If it's not real estate, then in corporate America, you get a UCC one on an individual or an entity in the case that you do a loan. And that is publicly available. They're not complex to file. And once you do a UCC one filing, you don't do that without a financing agreement. It doesn't mean that all of this person's assets are encumbered or this entity's assets are encumbered because they have a UCC one. It's not that you should ever be worried about having a UCC one in yourself. It may mean that you and your company are responsibly using debt. If you got a PPP loan, you have a UCC one filing, and a lot of small businesses got the PPP loans during COVID, right? So it's very proliferately used. This is just how the registry works. Ultimately, what we're doing though, if you kind of take a look at the cases, there's a lot of different kinds of litigation finance out there. We're in one specific niche where there's one kind of big, bad, evil organization that has mass harmed many, many individuals. And those, for example, like, have you heard of the Camp Lejeune water contamination?
No.
So and I actually own a couple of apartment buildings out in Jacksonville, North Carolina, near Camp Lejeune, and it's a military base, it's a Marine base where our soldiers went to go train to go to war. And for about 17 years, there was very harmful chemicals in the water, and the military, civilians, and their families all were exposed to this, and now they're having horrific illnesses as a result. And the DoD actually admitted responsibility. So they're liable for this. And there was a law passed actually to provide settlements to individuals which were exposed. And there's a settlement grid where it says, well, how long were you there? How long was your exposure? And then what was your disease? And then here's how much money that you can settle for. And that's an early settlement grid. So it's fairly simple case. The U.S. Judgment Fund is like essentially bottomless amount of money that they've allowed for people to exercise these claims. People can settle for these today, and they're anywhere from like 100 to 450,000. And we have about 2,000 of those claimants inside of our fund. So the idea is, and they just finished in August last year, not allowing any additional people into there. So at this point, it's a matter of We funded some people getting into it. And at this point, it's a matter of helping the attorneys fund getting these individuals through the process of getting their settlements. Now, they can either settle today at these kind of smaller numbers in the matrix, or they can settle in 2 or 3 years right now where they're going into more special circumstances and resolving larger settlements for specific ailments. And so that's an example of one that we're in. And so the collateral is fairly easy to value, right? Because the settlement grid's already there. Proof of exposure and your medical records are things that you can actually see and touch, right? You can actually do due diligence to see if they qualify. And so that's like kind of like the kind of very late staged kind of what we call mass tort, where it's just a mass harm. It's not a class action. That's a little different. This is when you have hundreds or thousands of people all singularly harmed by one organization. Other ones are like the Roundup. I don't know if you know Roundup weed killer or paraquat weed killer. Farmers and landscapers basically bathed in this stuff. There was EPA reports submitted and now retracted saying by Monsanto, now Bayer, that it was healthy. And it turns out it wasn't. And now these people have terrible diseases. And we have a couple hundred of those inside our fund where we're helping those individuals that were harmed get settlements. Another one is like 3M firefighter foam. That foam that military and civilians use to put out fires. It was terrible, right? That they said it was harmless. I mean, you said you couldn't injure yourself with this stuff. Turns out it's a forever chemical, and when you inhale it or it gets in the water, or contact, transdermal contact, it causes major problems. And so heroes of our society, these individuals working very hard, major corporate misconduct. And I think that's what's really cool about this. I mean, there's other ones. We're going after sexual assault victims, other really cool cases that you can be a part of that provide very meaningful settlements, hundreds of thousands of dollars to the claimants. And by the way, also provide really great returns to the investors.
Yeah, this is really interesting. And you kind of answered my question that I had next, which is when you're, lending against some kind of asset like real estate, it's pretty easy to value that, right? Right. There's not a big problem doing that. So how do you go about valuing these assets? You mentioned that in this particular case with the Department of Defense, I think the DoD is what you said, all these military families were exposed and they actually line itemized out, hey, based on the number of years living here and these factors, here's how much money this family can expect to get. And I mean, that's pretty cut and dry right there. And it sounds like that's pretty far along in the process too. Like that's kind of towards the, the end of it. When you're dealing with attorneys that come to you and say, hey, I need to get a loan. I've got this case. And usually I would think they're coming maybe towards the beginning of it when they've got a case. They don't have the money to, pursue it yet. And if they don't have the money to pursue it yet, and again, this is just how I'm thinking about it, then there hasn't been an outcome decided. And if there hasn't been an outcome decided, we're not sure what the compensation is. So if I'm reading this the right way, if that does happen, like how do you go about valuing those types of cases that haven't completely played out yet?
Well, it's a really great question, and I'm glad you asked that because, like in any industry, there are kind of these speculative and really early on investments, like I did in 2009 and 10. I was in a pre-development right before the subprime mortgage collapse, lost everything, and there are those people in real estate that are, setting up out in the desert trying to make the new Las Vegas, highly speculative, right? Not a lot of proof right there, not a lot of comparables. In oil and gas, there's people wildcatting. Early on, there's no real proof that there's oil and gas here. They're just hoping to make it big. They're hoping for 100x returns. There's angel investors, right, out there. We don't do any of that. So I have learned my lesson to not try and double and triple and get rich quick long ago. And so when I say we're an asset-backed based lender, we are actually looking with very late staged cases, right? I don't even want to play the game of 30, 50, 100x returns. As you say, when it's so early on, there hasn't maybe even been a court filing. Maybe there hasn't been a consolidation. Maybe there hasn't been any trials that happened. where they've been able to show causality. What was the ailments these guys have caused by exposure to this thing? And was there liability? Is the defendant liable for exposing, which ultimately caused these ailments? And until all this happens, it's highly speculative. So in our specific diversified litigation portfolio, when we look at mass torts, these large or mass amount of people were harmed by these one defendants, we're really late stage. And that's what we talk about. We're late staged in that. And we would like to be as close to the last dollar in. We want to be, the case is already filed. It's already gone forward enough to where they're in settlement discussions. It is then, we then have the ability to underwrite, as you say, to value. And that's either because there's a settlement grid already, or there's already settlement discussions, or there's already other settlements for the same thing, like the same case for sexual cases. There's already been settlements for the Roundup. There's already been settlements for the PFAS forever chemicals. There's already been settlements for, we're working on, right now we're underwriting infant baby formula, toxic baby formula. There's already settlements. So unless it's really far along, really not interested. So I'm an asset-backed kind of patient individual now. And so we want to only get into cases in which we have a very high degree of confidence in law firm valuations specialist ability to underwrite that value, and for us to lend on it, and for us to have a very strong degree of confidence that we're going to get it within a reasonable time frame. I think the other thing to think about is 90% of civil cases settle already. So it more so is the game of settling. And if you're really early on in speculating and you're going for 100x returns, you could lose because it can never get filed, or, can never make it into the courts, right? It could be, there were people in Camp Lejeune 10 years ago trying to get this through into the courts, and they finally did, right? And now they finally cut it off and said, now we're settling them. That's when we get involved. But my general sense is we want to make sure that people understand that if you're so late staged, it's more of the game of settling. And oftentimes that's driven by the insurance companies, right? And it's more the function of, can you lend with strong asset at very low loan to value and get a preferred position to where the volatility is going to come out of the top end, right? It's going to come out of the borrower's pocket. We have a very strong preferred return on our initial capital, and then a waterfall return on our profits. But that 5-6x return that can come back, if that ebbs and flows and it raises and lowers, it doesn't really affect our return so much because we're at that senior position, that bottom of the capital stack. Does that make sense?
Yeah, I see. Yeah, it's like a bucket that fills up. Yours fills up first, and you're kind of done at that point. You're out, and then if it continues to fill up significantly more, and 100x, then you might not get that, but you're like the first ones that are paid off. That makes total sense. This is really interesting. So you're using other cases to compare to that have settled in that case if it's not further along, but it sounds like most of the time you're looking at it and it's kind of a little bit further on. There's not as much risk because enough has played out for you to get a very good, confident feeling or judgment that this is going to at least fall within a certain price range. What kind of loan to values of the settlements or the cases are you usually lending on?
Right now, it's usually between 10 to 20%. We have the ability to go as high as 40% in the fund.
Oh, wow. Okay. So very, very low loan. Why so low?
Well, actually, it's very interesting. So if attorneys, oftentimes when we are lending to a law firm, they have they have thousands of cases already. And they're saying, hey, I need some money to either get some of these cases across, or I need some money to get a bunch more of the similarly harmed client. Turns out it's not that expensive to get more and more people. These attorneys use marketing. They have a marketing wheel where they spend money and they attract more people that were similarly harmed and they stack more and more people. And for them, representing 1,000 versus 10,000, not that much different in terms of their cost to get them through the legal system. So they don't need huge amounts like in real estate. If you're going to build a 1,000 unit building, it's going to be very expensive to build a 10,000 unit building. And in litigation funding, a 1,000 unit building might be the same price, or won't necessarily be double to do a 10,000 client list. Does that make sense? So it doesn't kind of scale proportionally. So a lot of what we're doing is like we're lending against diversified portfolios of within even a borrower. So like one is Camp Lejeune and Roundup. Another one is sexual assault cases in LA County and Maryland. And so we kind of get a diversified pool of cases there. We have a term sheet right now for one that involves several different, it's like 4 different mass torts, and each of them have hundreds or thousands. And so it gives us that ability to be first position essentially in all of these, first paid off in sort of all of this diversified portfolio of cases. And that allows them to run their marketing wheel. And then the more people they get added to what they call their docket, the more clients they get added. It's basically big win for them because they're going to put in that work anyways. So it's additional contingency fee they wouldn't otherwise have. It also makes them scarier to the defendant because the more and more people, the bigger the settlement against them. And so it gives them more of a motivation to settle sooner until the judge gavels down and says, hey, look, no more clients can come in, no more claimants can come in, like they did in August last year for Camp Lejeune.
Oh, interesting. Okay. So if they've got a big case that affects I'm thinking of this as individual, but if this is a case that's going to affect a lot of people, they need money to get that out there to the public to go, hey, if you've been affected by this, I mean, we see the TV commercials all the time. If you've been affected by this, call this number. There's a settlement in your name. They need the funds to put those commercials on to get as many people that have been affected as possible on their side of the bench, because the defendant, these companies, I'm assuming most of the time you're probably working cases that are not like person to person or individual, like a car wreck or something. This is like bigger cases against large companies that have committed massive harm. Then that makes that company want to settle more because they're like, oh God, if this goes to court, the more people that they've got, the less likely it is that we're going to win. So let's go ahead and settle. And that's a win for the attorneys and a win for the people that have been affected because it doesn't drag out in the court system for a really long time.
Yep. Yeah. And so that would be like the mass tort concept where, I don't know if it's the more likely they'll win because of the more claimants they have, but certainly the more damaging for the defendant, the more claimants that they have, right? Because it's a bigger payout. So they're motivated to settle sooner. But that's kind of like the mass tort side where, again, it's not class action. Class action is not meaningful settlements. It's like $50, $70, $80. Like we're talking really meaningful settlements for the clients. And then there's kind of the single event stuff where we have portfolios, like I said, of sexual assault cases. It's a little bit different, right? Because those are actually individuals and it's just horrific. Like the LA Juvenile Detention Center, for example, we've got a bunch of these where these people were, these organizations did not take care of individuals, and they also did not report the issues that were happening, and they didn't fix them. And so when that happens, and I mean, there's a lot of examples of these out there. There's been complaints, Catholic Church, Boy Scouts are kind of the more like bigger names that you see. And we're not going out to Catholic Church or the Boy Scouts, to be clear. But in a lot of these cases, in prisons, detention centers, the hospitals, they just work to cover it up, right? And they didn't actually go to. So each of those settled individually. That's another kind of case where each of those settle individually. And then the other kinds of cases are like labor claims, for example, where maybe there's wrongful termination, like in California, and those kind of individually settling claims. And those happen fairly predictably and fairly soon. So you kind of mix some of those kinds of claims to some of these larger claims, and you have a diversified litigation portfolio. And with the preferred position on the payouts, it helps to really give some principal protection and to provide that early return on your invested capital. And it also means that you, like in real estate, or me, like in real estate, because we have our real estate deals, we can put some capital as an investor. You can put some capital somewhere, and you feel a little bit better about it than your real estate portfolio because it's in the legal industry. It doesn't have any of the same market fundamentals. The legal industry doesn't care about interest rates or eviction moratoriums, or it doesn't care about the stock market. It doesn't care about oil and gas. It doesn't care about anything what's going on. In America, we're famous for that rule of law and our judicial process here. And so, that we put something there, it may not be super predictable about when those returns come in, which I think everybody now should believe real estate's not that predictable either, especially given the downturn we've seen. But you'll know that you have something that when it comes back, it's not going to be affected by this wild ride that the rest of your portfolio is on. And that sense of non-correlation and stability is what the real draw is, and why hedge funds, sovereign funds, private equity firms, the more wealthy, and if you look at our slide decks of how people allocate, that's why investments in legal and medical, those ways, they're so sought after, because it truly builds that hedge, that security, by being in truly diversified, non-correlated investments.
Yeah, and if you don't know, the non-correlation is so important for protecting wealth. Ray Dalio talks about how you need at least 8 different non-correlated investments, and the whole alternative asset world has just exploded, but it's still relatively small and unknown. I mean, I was reading how you can invest and buy shares of sports teams, right? I was like, oh, interesting, sports teams, because if you look at, I think the top, don't quote me on this, but it's something crazy. Like if you look at like the top 100 shows, like most watched shows, I think like 75 of them are sports shows, something crazy like that. And like sports aren't going away anytime soon, right? So you can own pieces of professional basketball teams and stuff like that. So it's the non-correlation of those types of investments is so important to a portfolio. So you're preaching to the choir here. I totally agree with you. What kind of what interest are you charging the attorneys? How do you come up with that? And then how do investors make money in all this?
Well, so we have a Reg D 506C offering. So we issue, LP shares out there, and it's a diversified pool. That's why we call it diversified litigation portfolio. And so investors invest, and then it gets split up against all the assets within the fund. I have a 3 to 5 to 7 year kind of time frame where it's not back ended, it's kind of middle loaded, because the more the settlements come in, it's a little different. You got to put on a different thinking hat than real estate, because in real estate you just have like 2 exits, maybe a refi and a sell. But if you're in a bag of different thousands of different cases, you're going to have lots of settlements coming in, and so the majority of your return of capital and return on the investment can be in the middle. And at the end, you have make some trickles. So it's not like 5 years or 7 years. It's like really, it's kind of that middle loaded investment. So we don't necessarily do interest rates. And you can think of it a little more like equity structured like debt. The lending agreements with the attorneys, like I said, they have kind of a lot of them, not all of them, but most of them have kind of 100% of the capital back and they don't get anything, right? Until they get 100% of the capital back. Some of them are fee sharing agreements where we kind of have a capital back and a split, or different versions. But for the most part, there is a return on the initial investment plus some, and then there's a split of the profits, a waterfall split of the profits. And as the deal outperforms over time, like as the attorney does better and better above our loan amount, they take more and more of the deal until a cap at one point. So it's not just principal and interest payments. And I think that's what's kind of cool is like real estate debt, even though they're at like 60, 70, 80% loan to value, sometimes our fund's not. We're at like 59 because it's a recessionary income fund. It's a really strong recessionary resilient fund, but a lot of them are high. And you're kind of capped. It's a principal and interest payment. I think what's really neat about litigation funding is you're not capped, right? You're doing these financing agreements, but you get to not only get some of that downside protection and non-correlation, but you also get to participate in the upside. So it gives some really exciting, and our internal rate of returns usually range from like that, 20, 25 range, maybe sometimes 30, depending upon the deals.
Interesting. It's almost like you're an equity partner in the case with the attorney, almost.
Well, you're not equity partners because we're not attorneys.
Right.
Uh,
It's not, you don't own a share of the, their practice, but in that deal almost, it's kind of similar. I know it's a debt structure, which is more favorable than equity, but the way it behaves, I guess you could say, it's like you get a piece of that deal and not a fixed amount.
yeah, you're hitting on the real heart of why litigation funding is a service to attorneys. And the reason why is it's because unlike other businesses where if they have something, if they have a really good asset with a great exit coming up, they can do like a Series A, Series B, Series, and just raise all this capital. But what happens when you do that? You have a board of directors, you have all these people coming in, making decisions, but attorneys have ethics issues, right? They can't bring in non-attorney partners. They can't bring in people that would conflict with that attorney-client privilege, that would take away their fiduciary responsibility to their. So there's no partnership, there's no real equity stake in the law firm. We are purely a lender. They operate the case, they work with their client. We have no attachment to the client, we have no say in their case and how they go about what they do. And that is what makes it different. So it is a little bit tougher for attorneys than to raise capital, because normal capital raising avenues requires those partners to have a say in the business, right? They want that. So these debt financing structures for attorneys give them that ability to compliantly raise the capital they need to then allow them to participate in contingency fee-based engagements, but without violating their ethics issues.
And this is some cool stuff. Very enlightening. Patrick, if people want to learn more about you, learn more about your business, learn more about this really neat investing option for their portfolios, where can they go?
Yeah, so well, passiveinvestingmastery.com is the website, passiveinvestingmastery, all spelled out.com. And if you go to passiveinvestingmastery.com, you'll see on our website, we have our acquisitions fund, our debt fund, which is an income fund, and we have our litigation portfolio, diversified litigation portfolio. If you'd love, I'd love to chat with you. There's a link to schedule a meeting with me. Part of what I love to do is just talk to investors. I used to be high tech guy, and now I'm full-time investor. And part of what I love to do is just people point in the right direction. I also offer a book. I collaborated with some other really cool people. Phil Cullen, lead guitar at Def Leppard, an actual rock star, some NFL, NBA players, some entrepreneurs, Navy SEAL, and we all did a chapter in the book. It's called Lessons from Thought Leaders. It was such a fun book. And if you would like a copy of that, I give them away. I sign them and give them away. So you can go to passiveinvestingmastery.com/book, passiveinvestingmastery.com/book. And inside there, as long as you put where you heard about me from, you get a lot of random form fills, and I don't send anything out. You can also download the ebook if you want, but I'll literally sign it and ship out a copy to you. And I hope that helps to inspire you along your journey, regardless of where you're at. I tell my whole story. I lost it all, the ebbs and flow from high tech and making my way out into real estate, energy, and debt, and commercial, and legal funding. So happy to have that. If that inspires you along the way, I'm happy to get that book to you.
Very cool. Make sure it gets posted in the show notes so people can access that link. Patrick, it's been a pleasure having you on the show today.
Yeah, appreciate your time, Brandon.